Once more, very much welcome. Please, Jungsuk, the floor is yours.
Okay, thank you, Per, for nice introduction and organizing this wonderful event. So my name is Jungsuk Han, but Swedish colleagues all call me Jungsuk, so Jungsuk is fine. Okay, so I'm gonna review literature on bubbles, but with a certain angle on it. I'm gonna focus on some practical perspective, especially whether we have to invest in bubbles or not. So that's the topic I want to discuss today. All right, so let me just start with some motivation and introduction. So you may disagree with me, but there's some common concept that academics believe in efficient markets. Therefore, there's little interest in bubbles. Surely there was some dominance of efficient market theory at some point. However, not all the academics believe in efficient markets. Actually, most of us do not. And even efficient market proponents, they don't believe the market is always efficient. There can be temporary dislocation from efficient prices. In fact, there are a lot of papers, large volume of academic literature on bubbles. The issue is that the problem is there are too many to follow for non-academics. So today, what I want to do is I'm going to selectively choose those papers which could be potentially useful for practice. So that's what I'm going to try today. All right. So what can you learn from academic literature about bubbles? I'm going to look at two sides. One is theoretical side, and the other is empirical side. The theoretical side is just pure mathematical thoughts, like modeling of financial markets. And then we'll see how theoretically bubbles can happen and what's the implication and all that. And empirical side is testing bubble with actual data or experiments or detecting bubbles in real time and so on. So you'll see that in theoretical side, there are actually different types of bubbles. And they have different implications, especially for investing and social welfare and so on, and policy as well. On the empirical side, there are a lot of different methods of detecting bubbles and testing bubbles. So far, what's happening is it's rather inconclusive because it's very challenging, very hard. So I'm going to talk about that as well. All right. So what's the agenda today? As I said, the ultimate question I want to answer today is whether to invest in bubble or not. For that, I'm going to review the literature in this order. First, I'm going to talk about the theory of bubbles. What types of bubbles are there in theory and their implications. Second, I'm going to talk about different definitions of bubbles and connect that with the challenges of empirical testing. Actually, these are two connected topics. There are really different definitions of bubbles, and that is actually causing some challenges for the empirical tests. And finally, I'm going to talk about who are the winners in this game of trading bubbles. And there are some bonus tracks. I'm going to talk about currently the hottest topic, Bitcoin. And I'm going to give you some references. So we'll distribute the slides, if you want, by email. So there are all the reference papers, academic literature for any of the things I'm talking about. I'm going to talk. So even one sentence, this is like one sentence summary of 100 pages academic paper. So if you're interested, you can actually take a look at them. All right. So let me start with the theory. So as I said, there are different types of bubbles. Not all the bubbles are equal. So we have to know what kind of bubbles are there theoretically and think about implication of that. All right, so what's the most well-known type of bubble when people think about bubble? That is irrational bubble. So in this story, people are overly optimistic and they don't even realize that there are bubbles. and prices just going up, and then they keep buying it, even when price is far greater than the fundamental. That's a standard definition of bubble. Price is far greater than the fundamental. I'm going to talk about other definitions later, but in this episode of Irrational Bubbles, people become over and over optimistic, and it's actually escalating, irrational exuberance. So prices just go up to the roof, and then people still don't realize that. That's typical irrational bubble. Many people think about that. However, in academic literature, we don't only look at irrational bubble. In fact, the other type of bubble is bigger interest in academic theory, namely rational bubbles. By the way, this rational bubbles term in academics is rather narrow concept. So I'm gonna just talk about rational bubble, anything not irrational bubble. So in this story, people are rational, unlike irrational bubbles. Of course, there are irrational bubbles, but there are rational bubbles. So what's the difference? In rational bubbles, people know that there are bubbles. They realize that it is a bubble. However, they choose to invest in the bubble, unlike the irrational case. Irrational case, they are just investing because they don't know it. But in rational bubbles, they know that price is far higher than the fundamental. However, they are still investing in it. So why is that? That's the theory of bubbles. And in fact, that is very hard. Why is that? This is actually one of the foundations of all the finance theory. So in finance theory, there's a law of one price in a perfect market, and when people are rational, because of arbitrage. So whenever there's mispricing, people run to exploit that. This is just free money. So soon, this opportunity disappears, meaning that mispricing disappears, price is equal to fundamentals. So whenever you see mispricing for obvious cash flow today, people will do arbitrage, then price will become fundamental value. This is arbitrage because there will be no mispricing tomorrow. Today, there cannot be any mispricing. So whenever there's some deviation from fundamental value, people will run to arbitrage. And if there's no mispricing further into the future, this chain of arbitrage will eliminate any possibility of mispricing even today. So at any point of time, because of chain of arbitrage, there cannot be any mispricing. So we cannot have any bubble in perfect and rational, perfect market with rational people. So bubble is not possible in theoretical model, often. So how can we actually have bubbles? Because in real life, we have some bubbles. In fact, it turns out it's not that hard to generate bubble when you make them assumptions of models a little bit more realistic. So I said, rational investors, perfect market, arbitrage. So if we just loosen up one of these link, we can easily have bubbles. So we make people a little bit less than rational, or make the market a little bit less perfect, or we break the chain of arbitrage a little bit, make the arbitrage a little bit harder. Then we can have theoretical bubbles. Now you know all the core idea of the finance literature about bubbles. So here it is. Market imperfection. If market is less than perfect, bubbles can arise. Why? Bubbles actually fill in the gap in the financial market. The market instruments do not give you all the opportunities you need. So bubbles actually fill the gap, and people use that rationally. One of the examples is cash. People use cash as store of value, or for transactions and liquidity and so on. Cash itself doesn't have any value. The value is zero. However, the price is non-zero. So that's theoretically a bubble. We'll talk a little bit more about that later. So this is making the market imperfect and creating bubble. The other link, I said there's arbitrage activity, which enforces law of one price. So when we make the arbitrage a little bit harder, let's say put some short sale constraint and margin constraint, some constraints on the arbitrageurs, then we can have bubbles. In this type of bubbles, they do not really help anything in the financial market. It's just there, sort of overpricing. However, people cannot attack that because they are tied their hands in terms of their constraint, liquidity constraint. They have less capital to correct the mispricing. So knowing that this will not be corrected, well, why don't you just write the bubbles? That's the idea of limit arbitrage. So we break the link of chains of arbitrage. Financial intermediation. This is another form of market imperfection. So there are ultimate owners who owns the actual assets. However, they don't participate right away. They go through some intermediaries, financial intermediaries, delegate investors, and their incentives are misaligned. And this can create bubbles. So this is one of the arguments about subprime bubble during 2006 and 8. So these are the link about financial market imperfection and arbitrage. Finally, as I said, we can loosen up the assumption of rationality, make the people a little less rational, and this can create bubbles. The reason we can easily create bubble with a little bit less rationality is that it's about group thinking. Market is a place where a lot of people are interacting together. So when you have one person, then this person becomes a little bit less rational. This doesn't create too much problem. When you have a lot of people with a little bit of less rationality, it can amplify. This is actually called boundary rationality, meaning that they know they have a little bit of irrationality. After all, we are all human, so we cannot be perfectly rational. And then we know that. Even though we know that this doesn't cure that issue, because there's group thinking. So in financial markets, boundary rationality can easily create bubbles. Okay, these are the major theories. Okay, so we know that there are different types of bubble. Now the question is, will they burst? Many people think that bubble will eventually burst. That's not entirely true. In case of irrational bubbles, this is kind of one of the main bubble people think about. Indeed, they almost surely go burst because people initially don't know it is a bubble. They just invest because they are irrational, optimistic. But then at some point, they will all realize this is a bubble. More and more people realize, of course, the burst will take time. There will be some delay because there's issue of coordination. However, at some point, if enough people realize that it is a bubble, it'll go bust. So this kind of bubbles will always burst. What about rational bubbles? Rational bubbles do not necessarily burst, unlike irrational bubble. So it really depends on the nature of the bubble. So some bubbles will just last forever, like cash. On the other hand, other bubbles may go bust, depending on the driving force. If the market imperfection disappears or limit arbitrage is corrected, then this bubble will go bust. And even though the driving force is still intact, it can still go bust because of outside shocks, such as change in regulations or economic conditions or weakened investor confidence about the bubbles and so on. So bubbles can go bust, even in the rational case, but not necessarily. All right, so as I said, the ultimate question we want to answer today is whether to invest in bubbles. So let me get to that here. The answer is, it depends on the type of bubbles. And actually, the theory already tells you what to do about each type of bubble. As I said, in the irrational bubble, people don't know that it is a bubble, and they just went in. So in this case, if you realize that it is a bubble, we should just avoid it, unless you can time the market. But as I will show you later, timing the bubble is actually hard. So most of people should just avoid irrational bubble. We shouldn't invest in that if we know it. In case of rational bubble, as I said, people realize it is a bubble and they are still investing in it. They know there is a bubble, they are investing in it. This already tells you something. we have to invest in it because this is optimal for the investors. They are choosing to do it because it is profitable. So in these cases, let's say, bubble that never go bust, like cash, they just use it because it gives you liquidity and store of values, all this convenience yield. But then you may ask, okay, you said even rational bubbles can go bust. They can burst. So how do we actually invest in some bubbles that may go bust? Well, in that case, we actually get some risk premium. We should get some risk premium if it's really rational bubble against this risk of bursting bubble. So if it's fair game, like any rational investment, investors should get compensation for the risk they are taking. So is the case with the rational bubbles. If you are rationally investing in some bubble voluntarily, we are doing that because we are getting proper compensation. So if there's actually risk of burst, we have to get compensation for that, risk premium. That's why some bubbles grow fast, if they are actually rational bubble. And another type of bubble, boundary rationality, we can make people a little bit less rational in the model, and then this can create bubbles. This is really in between case between irrational bubbles and rational bubbles. So it's really case by case. But for the time's sake, I'll skip this part, but they have both elements of this, what to do about the bubble. All right. Now then, we know that individually, we have to invest in some bubbles. We should also avoid some bubbles. But what about social perspective about the bubbles? Are they any good? Or are they always bad? Well, the common concept is that a bubble is bad. It is indeed true in usual case. Bubbles are bad. Why? Because they distort the price. They misallocate resources. Resources are allocated in the sector where they have high price, right? So they overinvest in some sector, there are bubbles. This is bad. Furthermore, bubbles create really bad aftermath, negative spillover effects, such as fire sales and illiquidity when they go bust. So bubbles are bad in that sense. However, bubbles can be good sometimes. As I said, if there are market imperfection, if bubble is filling in the gap, this is actually giving you new investment opportunity. So it can be good. Furthermore, bubbles can promote innovations. Let's say there are some technological innovations creating knowledge spillover. But then this is actually public good. This will benefit others, not only the innovator. In usual financial market, this cannot happen very well as a result. But then with bubbles, these technologists overpaid. So they may invest further, and this can create positive spillover effect to the society. So the point is that private optimality and social optimality are not always the same. Individuals may find bubbles beneficial when it is bad for society. Individuals may find bubbles are not that attractive when it is beneficial for society. So we have to think about in which case the bubbles are beneficial and bubbles are not beneficial in social perspective. But in summary, my point is that bubbles are not always bad. It can be good sometimes, even in social perspective. So what to do with bubbles in terms of policy? Well, we can surely reduce bubbles if we want. There are some policy tools we can do that. But then the question we have to ask is at what cost? If bubble is actually helping the society for some reasons, let's say filling the gap in the imperfect market and so on, reducing bubbles may have some benefit maybe having better allocation of resources and so on, but then it can create other problems. So we have to think about the trade-off of these problems. And one of the issue also is about whether to increase interest rate or not to reduce bubbles. We have to think about first the trade-off of reducing bubble. Furthermore, there are studies showing that theoretically it's unclear whether lowering interest will always reduce bubble. It may, but maybe not. There are all the arguments about that. So I'll just leave it at that for the time's sake. But let me now tackle the more practical side of bubbles. These are the theories. So how do you actually apply it? So Per, I have 10 more minutes, maybe? Okay. So to talk about empirical side, I have to actually talk about the definitions of bubbles first. As I said, standard definition of bubble is simply price greater than the fundamental value, maybe far greater than fundamental value. But there are other definitions, especially about explosive price movements and so on. The issue is that people often do not agree on the bubble definition. Even though theoretically it looks easier, but it's actually harder than that. And taking a look at it, we'll realize that it's not just a matter of agreeing on the terminology. Actually, there's a deeper disagreement about this. Why? The reason is that we do not know exact fundamental value. Even though we agree on the term, we simply cannot. Let me tell you why. First, suppose that fundamental value comes from cash flows. We do not agree on the cash flows. It's because this is the expectation of cash flows. We might have different information. Furthermore, we might have even different beliefs. Somebody may be pessimistic, somebody may be optimistic, and so on. And we may actually have different beliefs about each other, higher order beliefs. Even though we agree on the cash flows, well, cash flows is not the only part of fundamental. The payoff of an asset may lie in something more than cash flow itself. It might serve you as some kind of liquidity vehicles, or it might loosen up your credit constraint by allowing you collateralizing the asset and so on. It might give you control rights of the firm and so on. So there are other values than just cash flow. And we might have different values on that. The biggest issue is actually not on the cash flow side, payoff side. Actually, it's on the discount rate side. So as we all learned in Finance 101, the present value of certain asset is discounted cash flow. So we have to think about the discount rate side. Discount rate is equal for everyone in a perfect market. But we know that market is not perfect. So we'll never have the same discount rate. Why? Discount rate reflects your risk attitude, your preference, and also your wealth. So we all have different risk attitude and different wealth. These are in a way connected. And when market is imperfect, this will imply different discount rates for everyone. So as a result, even though we agree on all the items here, because of different wealth and different preference and all that, we'll never agree on the fundamental value itself. So we cannot agree on it, not just terminology. Fundamentally, we cannot do that. Because we don't agree on that, actually, saying something is a bubble or not is almost impossible. All right, so let's get to the empirical side now. Let's actually look at studies about detecting bubbles and testing bubbles. Before going there, let's see whether we can tell something is a bubble or not. So this is S&P 500 index, inflation adjusted, blue line, and the green line is the earnings. These are the fundamentals. Well, you can put dividend or anything fundamental there. All right, looking at it, we can see that the price is going higher, way higher sometimes, compared to fundamentals. especially during the late 90s when there was the IT bubble. And now it's actually also very high. So can you say there was a bubble here or maybe there before subprime crisis or now? Well, the answer is no, by just this picture. Because, as I said, we do not agree on the prospects of fundamentals. These are just earnings. It's not actual earnings. We have to think about future earnings and expectation of that. So we may not agree on that. Furthermore, we have different discount rate. Your discount rate and my discount rate will never be equal. As a result, the fundamental present value itself cannot be equal. So for somebody, this could be bubble. For me, it may not. Or for you, it could be. And same picture emerges for housing market. So this is a housing market index, Sweden, US, and Japan. This is also inflation adjusted, starting from some index 100, 1970s. And as you can see, Sweden is doing very well. It's very high. Japan is not doing very well since 90s. Okay, but what about the fundamentals? These are just prices. Let's do it with the price to income ratio. You can put rents or any kind of fundamentals there. Or again, Sweden is doing too well. So you see, Sweden is far higher than US and Japan. So are we heading into another crash? Well, you never know. But then to say that, do we have a bubble in Swedish housing market? Maybe, maybe not. As I said, there are all these issues about definitions of bubble. We'll never agree on that. So for somebody, this is a bubble. For somebody, this may not be a bubble. So just let me leave it at that. And let's talk about what academics have done about detecting bubbles or testing bubbles. All right, as I said, agreeing on the fundamental value is really hard. But there are some special cases we can actually know that price is different from fundamental values. But these are only special cases. So I'm gonna just skip that, but you can take a look at the slide we'll distribute later. So let me just talk about actual tests. So as I said, except for only special cases, we cannot tell price is different from fundamental value because we don't know fundamental value. In that case, what they do is they just get around this issue and make some assumptions, especially some statistical properties of this fundamental value, and they do indirect test. The assumption there, in a simple word, is that things are stable in a way. The future will not be totally different from what we have today. So under this assumption, they can actually get around this issue of fundamental value. And they detect bubbles with that assumption. What are the issues in that case? Well, we made an assumption, not coming for free. It creates cost. Why? Well, the economic situation may indeed change in the future. Maybe there is high price because there are different fundamentals now. And then this method cannot tell that. And let's say, even with that, okay, let's say we just accept that. If the method says there's a bubble, okay, so what do? Do we avoid it or do we invest it? Actually, this method do not tell you what to do about practically investing or in that bubble or not. So that's the issue. And then even with these issues, actually they report that it's really hard to tell something is a bubble or not because of statistical power. We don't have enough data and so on. All right. So there are then second method, alternative method. They use different definition of bubble. Maybe this fundamental value definition is too hard. Why don't we just use explosive price? When we see explosive price, maybe this is a bubble. Or they make some mathematical formula from the past data. If it deviates from that, there should be a bubble. So they do that. That's actually easier than the first method. And they often detect something. However, there are still these issues. The biggest issue is that it has no attachment to the fundamental. So when we see something, this method is saying it's a bubble, well, how do we interpret that? There's no fundamental in it. Furthermore, all the issues from the first method is all there. There are all these assumptions about the stable the situations, meaning that if there are real big change in the economic situations. These cannot really detect it. Furthermore, this doesn't give us practical guidance about whether to invest in or not. So these are the issues. So the truth is that, well, not truth. Well, so far, the status quo is that detecting bubble is very hard, and there are big disagreement even among academic literature. So if you feel that you're left alone in the dark, you're not alone. Everyone is in the dark. So that's the good news, at least. And then let me make final remark on this. All right. I said detecting bubble is very hard. However, sometimes we don't really need sophisticated method to see something's unusual. This is Bitcoin price. And you know, to see this as bubble or not, we don't really need a very specialized method or some statistical thinking. This is just unusual. This has to be bubble. But then the question is, what kind of bubble is it? And then what to do about that? And that's the question. So hopefully I'll have time to talk about that a little later. So let me get to the point of who are the winners of this, the game of bubbles. All right. There are a lot of interesting stories to tell you, but then let me just summarize it for time's sake. The research find that people are not that all rational. Actually, the truth is that we have a little bit less than rational thinking, and there are actually different levels of rationality. So some people are a little bit more rational in terms of economic behavior. Some people are a little less and more. Furthermore, we have a strong tendency of having overconfidence. So we think that we can actually beat the others in this trading game. There's a very famous study. This is actually done in Sweden. People asked drivers, do you think you're better than others? And 70% of Swedish people replied that they are better than others. Uh-oh. So if more than half is saying they are better than half, then that's gotta be wrong. Somebody's gotta be wrong. And then people tend to believe that. I mean, they tend to believe they are all better than others. And this is the case with trading as well. They think they are better than others, and there's famous studies showing that the more they trade, the more they lose. The more overconfident they are, the worse they are in the trading. So people are overconfident about their ability. Okay. So, can we actually time the market? Well, in fact, as I said, there are different kind of bubble. If it's rational bubble, it's a fair game. You don't really need to time the market. Some bubbles will never burst, so we just stay with it. Some bubbles will burst, but in that case, if it's really rational bubble, you will get the proper reward. You will get the risk premium. If it's an irrational bubble, well, you have to avoid it because it'll burst, and then there's no proper compensation. But if you're actually good, you can time the market. But timing the market is very hard, and then people are often overconfident. So maybe we shouldn't do that unless you know that you are having some unfair advantage, like fast trading, private information, and so on. So we know that retail investors are overconfident. They lose money when they trade more. But what about professionals? So they actually looked at professionals' performance in the time of bubble episode. They found that during the IT bubble, some hedge fund managers actually rode the bubble. So they actually bought when the bubble is growing, and they got out at the peak, and they actually made money. And then there are all these other studies showing that they were successful in some other episode of bubble and so on. So some professional managers actually did well. But then there are also other evidence showing that even professional managers didn't do very well in the bubble episode. So let's say Wall Street security managers, in their own housing investment, they kind of found that actually they poorly timed the market. So this shows that even professionals sometimes don't do very well in timing the market. And who do better, who do worse? Actually, they find that young and unexperienced investors, mutual fund managers, didn't do very well in timing the market. They bought a lot at the peak and lost a lot of money. Compared to young managers, old managers with more experience did better in the time of bubble. Okay, so the evidence is that it's kind of mixed. So even professional managers are sometimes not very good in timing the market, but maybe or maybe not. So during the remaining time, let me talk about the hottest issue right now, Bitcoin. All right, as I said, money is a bubble because money has no intrinsic value, but it has non-zero price. It has to be a bubble, but it's a rational bubble. And it's sustainable. What's the difference between Bitcoin and existing currencies like dollars and krona? Unlike Bitcoin, dollars and euros and krona, these are legal tender. There are government and central bank backing the currency. Bitcoin doesn't have that. So as a result, Bitcoin's sustainability purely depends on the confidence of investors. So if we all believe that Bitcoin is sustainable, no matter what happens, it'll survive. If we don't believe that, well, Bitcoin can collapse any moment, even now. So then people say, okay, Bitcoin has this fancy blockchain technology. It makes a difference. Well, in principle, it does not. Blockchain technology per se does not guarantee anything. It's no different from seashells or paper bills or Bitcoin. It all depends on the confidence. Even with alien technology, if you don't have any confidence, well, it'll collapse. However, blockchain technology may indeed help. If it turns out if it's useful, safe, and so on, well, it'll help. How? Because we'll have more confidence in it. If we have more confidence in it, it may be sustainable. That's all. So what are the nature of Bitcoin bubble? Well, Bitcoin bubble may have some rational bubble element. It exists because there's a market imperfection. It actually has some store of value function. Well, transactions is weak, but it's growing. If somebody asks you, would you have Crona and Bitcoin? Maybe I'll have, you might say, I'll have Crona. If people ask you, would you have Bolivar or Bitcoin? Then it's kind of a tough question, right? So for some people where their currency is not very good, maybe Bitcoin might have a role, or Bitcoin has other roles of transferring money and so on. So there's a market imperfection, and Bitcoin is filling in that. So maybe that's why it is there from the first place. And Bitcoin, as I said, doesn't have any central bank backing the currency, so it purely depends on the confidence. So as long as there's confidence, it'll be sustainable, but as soon as confidence is gone, it'll go bust. And there's some feedback effect between Bitcoin value and the confidence. So sustainability actually is growing down and growing up with the price itself. So there's some feedback effect. Surely there's an irrationality component in it. There's just recent craze, too much enthusiasm, and there's self-reinforcing optimism. This is like a typical irrational bubble component. As price goes up, people become more optimistic. More people put the money in there, it grows even further. There's a boundary rationality component. There's large disagreement about future prospects. Some people say this is a new technology, this new future. Some people say this is worthless piece of money. So there's this disagreement. This can create bubbles. This is a boundary rationality component. And there's finally limits to arbitrage. Bitcoin bubble can be sustainable because there are all these constraints on arbitrage. There is short sale constraint. People cannot short sell. And also transaction takes a long time, actually, if you want to do cross-border arbitrage and so on. So there are some arbitrage constraints. So as a result, the nature of Bitcoin bubble is actually quite complex. It's a mixture of everything. Rational, irrational, boundary rationality. So we have to think about all these components. All right, so what's the final verdict on Bitcoin? In any case, Bitcoin is a bubble, whether it's irrational or rational. But then this doesn't mean that we shouldn't invest in that. We may or maybe not. So as I said, it depends on the type of the bubble. So we have to think about that. So if Bitcoin is really a rational bubble, this high growth of Bitcoin reflects maybe risk premium of bearing the collapse risk of the bubble, if it's actually rational bubble. But then surely there's an irrationality element in it. So let's say even though Bitcoin survives in the end, this irrational element may not survive. So maybe even when we are in a world where Bitcoin survive at the end, the price may be lower than the Bitcoin price right now. You never know. Finally, a cryptocurrency or virtual currency may become a major currency in the future. It could be Bitcoin, it could be Ethereum, it could be Ripple, or it could be some cryptocurrency we haven't seen yet, which doesn't exist yet. Maybe some cryptocurrency will be there in the future. If so, if it is not Bitcoin, then this currency will fill in the gap in the market of market imperfection. In that case, Bitcoin may not survive anymore because it lost its kind of a reason to exist. So actually, a cryptocurrency itself may be a good thing, but then it doesn't have to be the Bitcoin. So we have to be careful about that. So, so what's the theoretical price of Bitcoin? This is kind of the interesting part. In fact, if you look at the theory, there is no theoretical price we can tell about the Bitcoin. Any money-like bubble doesn't have any theoretical price. It can be any value from 0 to the total value of the economy. There's an upper bound. Money-like bubble cannot be bigger than the economy itself, of course. Bitcoin cannot be more valuable than the whole world economy. But then this doesn't help, right? I mean, Bitcoin cannot be that big. Well, but then there's something to think about. There's some food for thought. Total value of Bitcoin is about $14 trillion. It was on Sunday, but I'm sorry. This is actually, no. It's about $150 billion. This was on Sunday. It's changing any minute, so I'm not sure what it is right now. But then what's the value of dollars and euros? It's about $14 trillion. So compared to dollars and euros, Bitcoin is still very small. So if Bitcoin is ever going to be a major currency, maybe there's still some room for the growth. But at the same time, as I said, if there's a crash risk of Bitcoin, people have to be compensated for the risk premium. So to do that, Bitcoin actually has to grow. It has to grow fast until it stabilizes. But then if it's growing at this rate, and then if it doesn't stabilize by it reaches $14 trillion, if we still have crash risk, it's not going to be sustainable. I mean, this is kind of very wild thinking. So there's much need for the research. But then, yeah, these are the aspects we have to think about in terms of total value of Bitcoin. So this might give us some anchor about what is the price, proper price we can have about the Bitcoin, if it's ever going to be sustainable. All right, so that's the pretty much all the things I have right now. So let me just answer briefly about the main question I raised in the beginning. Should we invest in bubbles? My answer is bubbles are not all bad in theory. We should invest in some bubbles, but not all. We have to be careful about what kind of bubbles we are talking about. And then I'm going to finish it here. Thank you, Per.
Thank you for inviting me. Practitioner's view on bubbles. You don't get the sound. Like so. Better. I'll be very brief. Haruki Murakami, the Japanese author, said that whatever it is you're seeking won't come in the form you're expecting. And maybe it does. You're just not expecting it so soon. I'm going to talk about three things, three lines of thought, reflections. The first one is what we I'm an asset manager, what we asset managers do. The second one is the immorality of bubbles. And the third one is the distinction between a true progress that causes a price trend, like Apple, and a bubble, and the problems there. So if I begin with the first, what we asset managers do, and we are mostly trend followers. Actually, some people are not, but most of us are, because a stock market is mostly in a bull market most of the time. And if you don't invest in stocks and keep that investment, if you go against the trend, then after a few years you don't have a job anymore. So we are trend followers. And as Jungsuk mentioned, there's even a study by Brunnermeier and Nagel from 2004 about the IT crisis, where he studied very successful, very good hedge fund managers who owned a disproportionate amount of IT stock running up to the IT crisis, and they sold to the greater fool just before the crisis hit. So if we are like that, then you need regulation, some people would say, in particular if there is, to some people, recent evidence that a free market economy can be devastating, like in 2008. But note that that regulation came after the crisis, and as Trump said in Davos the other week, that, or did he say? He said that regulation is stealth taxation. So it's hardly anywhere. Regulation is not a growth booster. So if you have a downturn and you have regulation, that's pro-cyclical. And in fact, Eric Gerding studied, in another study from 2006, this phenomenon that regulation is always pro-cyclical. You had the Big Bang and you had deregulation running up and reinforcing the crisis before it happened, and then you have more regulation after the fact. So he says that it's always the case that politicians who are representing us, we have a representative democracy, they're also people, they're part of swimming in the same water as we are. And so do central bankers, I would suspect. So how can you cure this? Well, you have something called experimental economics. I didn't know it existed, but it apparently exists. So there was an experiment done before the global financial crisis, where they put people in a room. They told them to trade basically a fixed income instrument. They told them all the facts about it, and they put beginner investors to trade this, to play this game, and a bubble occurred. It almost always occurred, a bubble. Prices deviated from the fair value, and they were given the facts, so they could calculate it. They put professional investors in the room, and a bubble occurred. They then did what they thought they should test. They tested different pieces of regulation, like transaction tax, like circuit breakers, like position limits, and bubbles occurred. Sometimes it didn't occur. And they looked deeper into that, and they found that it didn't occur when they had people playing the game who had personally experienced a bubble and a crisis and felt the pain. I'm a little lost here. I'm going to skip some parts. Hayek was onto the same thing, actually, and it's a centuries-old discussion about lender of last resort from the 18th century onwards, and the question of moral hazard that it introduces. I'm going to read you a quote from a favorite movie of mine, because they make great movies, these crises. It's Margin Call. It's the character John Told. He's the poorly disguised Richard Fuld, former chairman of Lehman Brothers, and he says in Margin Call, and it's certainly no different today than it's ever been. 1637, 1797, 1819, 37, 57, 84, 1901, 09, 29, 1937, 1974, 1987. Jesus, didn't that fuck me up good. 92, 97, 2000, and whatever you want to call this. I might add 2008 and whatever you want to call this. It's all just the same thing over and over. We can't help ourselves. And you and I can't control it, or stop it, or alter it, or even so slightly change it. We just react. And we make a lot of money if we get it right, and we get left by the side of the road if we get it wrong. Leads me on to the second point in my speech, the immorality of bubbles. Some bubbles, as we've heard, emanate from investment fraud. We have regulations against that in Sweden, had it for a long time. The Mississippi bubble in France, in the beginning of the 18th century, it didn't involve any fraud. But the South Sea bubble in the UK, slightly afterwards, did involve fraud and quite serious corruption at high levels. But always, an angry crowd afterwards tries to find the villain, even if there isn't one. And if you've noticed recently, in Madoff, you can pinpoint an individual, but very often you just say there's something wrong with the system. And that's perfect if you want, because you can cure it with regulation to fix the system. So you blame speculators, you blame banks or bankers. You might even blame the instrument itself, the evil instrument, the derivative. I've spent my entire life trading derivatives. Derivatives, or it could be just this is not suitable for a market economy or market solution. You can't leave it to that. And even so, the relationship between immorality and bubbles is something that even today, when you talk about Bitcoin, you have some banks have said, we won't touch Bitcoin, we won't let our customers touch Bitcoin, and then you have others, and you basically know beforehand which they are, say that, well, it moves, so let's trade it. But virtue obviously has value against short-term profits to trade something. Virtue has value. And on the other side of the coin, what responsibility do I have? What responsibility do you have for that person's mistakes? So virtue is also personal. It's a personal thing. And I think we've forgotten a little bit about virtue. My third point is that market prices can deviate from fair value from temporary reasons, for many temporary reasons. And that makes investing on mean reversion very profitable. But sometimes, as Joseph Schumpeter wrote in 1939, his book buried by the war, some innovation comes along. And if you had sold Apple stock, say 20 years ago, because you thought it had gone up too much, the P/E ratio was hilarious, you've made a blunder of your life. Some people they're always in a mean reversion sort of state of mind, and I've done a lot of work with farmers. I was on, for example, the EU Commission's Agricultural Markets Task Force just 2 years ago, when after they burned tires in Brussels and Paris, you know. So farmers, they plant. If they lose the crop, they just plow and plant again. It's the same thing over and over. Just hope for the best. And they behave in the same way in markets. So if they want to hedge the grain price and prices go up, they sell. Now, professional asset managers like myself, we're trend followers. So if prices go up, we buy. And that's actually something good, that there are two kinds of people in the world, because we can trade with each other at the same time. We have a market. So we have a mechanism to transfer risk from producers to speculators or risk carriers. But how in advance can you know? Even Schumpeter says that the only traces you can see of an innovation is that the price has changed, because the cost curve must have changed somewhere. You can't find the actual fact. So you only see the price move. How can you know in advance if this is a bubble or it's not? If I may quote Mark Twain, "It ain't what you know, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." So I have talked very briefly about three things: what we professional asset managers do, what I do. We just can't help ourselves. The immorality of bubbles, the punishment if you get it wrong, and the difficulty in advance to discriminate between what is true progress and innovation and what is a bubble. If there's any finishing line to my short speech here, it is that bubbles obviously is a social phenomenon. It's with us all the time. I could say get over it. It's not a strictly financial or economic problem. In fact, the first book I read it was a long time ago, was McKays' book on popular delusions and the madness of crowds, and it's just not just about bubbles. Part of this is politics, and central bankers are part of this, naturally, of this cycle. So if there's any advice, and like most people in the financial world, after the financial guy spent a lot of time with regulation, so we come into that. But I suggest that less pampering of busted banks. All the support to Greece after the crisis is just fertilizing the soil for the next crisis, because we have nothing learned. The bubbles also create great drama and great movies, as I quoted from before, Wall Street, etc. The Great Short. They create debate. They motivate having a lender of last resort. Financial supervisors. Now we have a financial supervisory authority in ESMA, and above that we have BIS, and incidentally 2 knights in competition to protect us from bubbles. We have had a lot of low interest rate policy. We've had QE, and they're buying still today, some central banks, a worrying amount of assets. And they're certainly not acting to solve a temporary liquidity crisis anymore. They can make a political career. Some have done that out of bubbles. The point is, ladies and gentlemen, that bubbles, for lack of a better word, are good. Bubbles are right. Bubbles work. But maybe bubble fighting has also become a bubble. If you gaze into an abyss long enough, the abyss will gaze back into you. Thank you very much for listening.
Oh, it actually works. I can hold on to it.
Okay,
Yeah.
thank you.
I can make mine work. So that was lots of food for thought. Jungsuk, do you have any comments on Torbjörn, by the way?
Well, yeah, it was actually very good. Yeah, I mean, we actually had a chat a little bit before this, and then this kind of we pretty much like share the opinions on this issue, and then I think that's all the comments for now. Perhaps we want to hear more from the floor, I guess.
Yes, we do.
Yeah.
Please raise your hand, and we have a microphone over there. It doesn't have to be a question. It can be a comment. It can be sort of your opinion, anything. Over here.
In the beginning that bubbles are sometimes created by irrationalities, which can be in both sides. So if they can be negative bubbles in the market, is there any differences in economic theory handling those?
Right. That's a very good question. All right. So negative bubbles are possible, and then it can be created by irrationality as well. I mean, if people are irrational, anything can happen, really. Even if everyone is irrational, right? If people are optimistic, we'll have bubble. If people are pessimistic, we'll have negative bubble, meaning that price is far lower than the fair value. All right. Now the question is, what if we have some rational investors? Then we are in the world of limits to arbitrage. Then there will be difference in terms of theory. All right. In theory, it is easier to have bubble than negative bubble. Why? When we have optimistic investors, let's throw in some rational investors in there in the market. These rational investors will trade against optimistic investor, meaning that they will short sell the market. So optimistic investor will keep buying, but then if rational investors have bigger capital than irrational investors, they'll eventually cure the mispricing by short selling it. Now, how do we create bubble here? Limits to arbitrage. If we have short selling constraint, well, rational investors cannot do that anymore. So we'll have bubbles. But then, what if people are pessimistic? when people are pessimistic, what they will do is they will keep selling, but then there's a limit to that. And then rational investors who have capital, if they have enough capital, they'll keep buying. So they will eliminate any negative mispricing. As a result, we can have bubbles easily in the financial market because of short selling constraint, but then we cannot have negative bubbles, because there is no constraint, preventing you from buying it. So negative bubbles are harder with limits to arbitrage, but then even with the negative bubbles, it can happen if arbitrageurs are further limited. If they don't have enough capital anyway, then we'll have negative bubbles. But then if they have enough capital, and if short selling constraints the only limits to arbitrage in the market, we will not have negative bubbles. So theory says bubbles are a little bit easier than negative bubbles, but then both can happen in theory, but then bubbles are a little bit easier. Yeah.
Okay. While you think, I'll throw in one then. One question that has been asked a lot in Sweden the last couple of years is there a bubble in the housing market? Journalists keep calling up, is this a bubble, is this not a bubble? My first question is, why does it matter? Does it have policy implications? If it's a bubble or if it's just extreme fundamentals that has created very high prices? Is that a big thing? And the second, sort of just a reflection when listening to you, if it is called a bubble and if politicians believe it is a bubble, it seems to make them nervous to do something. Because if they prick the bubble and prices fall, they will not win the next election because people will be mad with them. And so maybe that might be a problem. Just the word sort of scares politicians from taking action because they are nervous about pricking a bubble. So the question is,
right.
I guess, basically sort of, does it matter from some sort of policy point of view if you want to manage the bubble, if it is or not?
Sure. Should I answer first?
Please, or Torbjörn, or both. Yes, please.
Okay, I'll go first, and then perhaps you can add. So my point was that it can be actually proper pricing. It can be a bubble. We just cannot tell it. So why it can be a proper pricing? Well, if we have some discount rates and expectation that fits the current price, it doesn't have to be a bubble. As you say, the interest rate is low. If with low interest rate, discount rate is small. As a result, present value can be very high. That could be the reason the price is high. Furthermore, it could be coming from the payoff. Well, real estate gives you not just the utility of using it, but it actually gives you other functions, such as loosening credit constraint. By collateralizing the real estate or housing, you can actually have extra liquidity. And especially during the time with the credit expansion, you can have more credit with this housing. So that actually gives you value. So it really depends on how you view it. So for some people, owning house is only about using it. But for some other people, maybe they own the house, and using that house, they have extra liquidity. With that, they invest in mutual funds, or they buy extra summer house, and so on. So it actually gives you extra utility. So for them, housing value should be higher. So it really, to whom you are asking, so it could be that. On the other hand, as I said, there are other types of bubbles, irrational bubbles. So maybe people are over-optimistic about the current housing situation. It has been going up and up. So they believe it'll just go up because it has been going up for the past 15 years. Maybe it'll still go up for the next 15 years. They just keep buying, and then they don't realize that that's a bubble. It could be the case, but actually the detecting method I mentioned, people have done it with the Swedish housing market as well. So you can easily find that on the web. The problem is that it's not conclusive. What they can tell you. They will tell you some guidance about that, but then we will never know that whether this is true fundamental changes or whether this is just irrational bubble or and sort of that. And And finally, another point is that, I don't know why, maybe I should get away from that speaker. Right. Oh, maybe not. Maybe I'll just talk. Is it okay? So,
You can have the microphone.
oh, okay. Thank you. So, and yeah, my point is that if it's rational bubble, we can still invest in housing market even though it's a bubble, because it's actually giving you extra functions. But then, it's really up to you whether you see whether it's a rational bubble or irrational bubble. I mean, it'll require further research to really tell that, and then maybe we'll never know.
Just a follow-up question before I give the word to Thomas. Let's assume that we know that the Swedish house price development is an irrational bubble.
Mm-hmm.
Should politicians prick it? Should they do something to sort of kill the bubble before it gets too late? Or does
Right.
theory have any guidance on that?
Yes. So bubbles have negative side and positive side. The negative side is misallocation of resources. So because housing is so expensive, too much money is going into the sector, and then we are having oversupply of housing. If that's the case, that could be the issue. Then they want to perhaps prick the bubble, reduce
Right.
it. But then the negative side of bubble is actually coming from also the other side. If you prick the bubble, when it go bust, it's going to create this bad spillover effect for a long time. It'll create illiquidity, fire sales. So it'll form another form of misallocation
But it
of
will
resources.
eventually burst anyway.
Well, it depends.
Okay.
So if it's well, there are couple of cases. People may not realize for a long time, and maybe what they hope is maybe fundamentals will catch up. It's kind of form of bursting, but then kind of slow bursting. Maybe then there will be no negative consequences from that. The other thing is maybe there's some limits to arbitrage. Basically people cannot, people see the bubble, and then they know it's even irrational. But then those who are rational cannot really crack that. That case, that can last forever. So in that case, we'll have permanent bubble, which is not bursting. So I guess it depends. Yeah.
Okay. Thomas, and the microphone. So we can hear him.
Thomas Franzén. Well, if we look at the stock market in US, it has gone up tremendously. And the background is absolutely not that investment have been very high. On the contrary, there is a problem that investment had been very low, and the World Bank is worried about that potential output is growing at an extremely low pace at the moment. So one important reason for this is probably extremely low interest rates have really been the reason why the stock market is so high. And then one wonders, because if we ask the central banks, they are trying to push down the interest rate in order to get the investment rate up. But they have not succeeded in doing that. So in your terms, it can be that, and in your terms, they are swimming in the same water. They are trying to solve a problem in the market by an extreme monetary policy. And in that way, they have created a bubble in the way you are describing it. And what is then coming back to the question, should one lean against the wind? Yes, if there are two consequences of it. One is the interest rate level. The other is the reasoning behind. If you combine leaning against the wind with an analysis which is really credible, then it is difficult to say that you shouldn't lean against the wind. And the effect will be both analytical and technical from the interest rate side.
Torbjörn, any comments?
No, I agree with almost everything you said. It's a big experiment on the trickle-down hypothesis, which was tested some 40 years ago. It didn't work, I think, that time.
Jungsuk?
All right. So, in my view, for the government, I think the point is not really whether we have bubble or not. The point is, as you say, they want to create investment, actually not in the stock market, investment in the real sector. So, if what it takes is a bubble, maybe we are willing to take it. As I said, bubble has good side. Let's say we need innovations, but then innovations are not only enjoyed by the person who invented that. That actually have spillover effect to others. So actually, those who are enjoying this technology developed during the maybe 90s and so on, it's all the consumers and other firms. But then, if you just leave it to the private individual entrepreneur, they don't have enough incentive to do that. So bubbles can actually help that, giving them extreme valuation. We actually pay them to invest in the technology, and then we all enjoy that. Now, this argument can be applied to the argument you are making. Unemployment and employment, all this, let's say, employment in general, or investment in real sector, this is a public good. We want to have that. But then, with the fair pricing, we cannot incentivize private sector enough. So maybe by making a really high valuation, it can be bubble. It can be just really, high valuation because of low discount rate. Whatever it is, if we can incentivize them enough, and then more than actually what they can, get from fair price, well, we can enjoy all the consequence, because employment, in a way, is public good. It helps all the economy. So I guess that's what they are aiming for. So in that sense, maybe they shouldn't lean against the bubble until we are, back to normal. That's what they have been doing. But then maybe they think now they have done enough. Maybe they have to get back to it. But then there are all these complicated, macroeconomic, monetary, argument behind that. So this is only the, one aspect of the issue.
Okay, it's 9:14, but you get it. Okay, in that case, we run out of time, and it's time for you to go out there and save the world from whatever bad things are happening right now. Thank you very much for coming, and hope to see you here again soon. Thank you.